All right, today we're going to demystify a really powerful, but let's be honest, often misunderstood part of the financial world, and that's futures trading. So let's dive right in.
Have you ever wondered how people are actually making these bets? How can someone today make a legally binding deal based on what a price is going to be weeks or even months from now? Well, the answer lies in something called a futures contract. So, before we get into why anyone would trade these, we've got to understand what they are. So, let's start with the absolute basics. What exactly is a future? At its core, a futures contract is pretty much what it sounds like. It's a contract about the future. It's a standardized, totally legally binding agreement between two people. But an agreement to do what exactly?
Well, every single futures contract, no matter what it is, boils down to three key things. First, it spells out whether you're agreeing to buy or to sell a specific asset. Second, you lock in the price for that deal today. And third, you pick a specific date down the road when it all happens. That's it. That's the core agreement in a nutshell.
Okay, so why on earth would anyone want to do this? It turns out there are really two main reasons, and they're kind of polar opposites. Let's take a look at hedging versus speculating. So on one hand, you've got hedging. This is all about playing defense, protecting yourself from prices swinging the wrong way. And on the other hand, you have speculating. This is pure offense. It's about taking on risk because you're hoping to make a profit. These two groups actually need each other to make the market work. The hedgers pass their risk over to the speculators, who are more than happy to take it on. A classic, real-world example of hedging is a farmer. Think about it. They have no idea what the price of their wheat will be when it's time to harvest. So to get rid of that uncertainty, they can sell a futures contract today, locking in a price. That way, they guarantee their income no matter what the market does later. So we've got the what and the why. Now let's get into the nitty-gritty, the actual mechanics of how this trading works. In trader talk, if you think the price of something is going to go up, you go long. This just means you buy a futures contract, agreeing to purchase that asset at the price you locked in, hoping you can sell it later for more. Simple as that. And you guessed it, the opposite is going short. If you're pretty sure the price is headed down, you sell a futures contract. You're agreeing to sell the asset at today's price, hoping that by the time you have to deliver, the market price has dropped and you can profit from that difference. And the sheer variety of what you can trade is just massive. This isn't just for farmers anymore. You can trade futures on things like crude oil and gold, on financial stuff like the S&P 500 index, bonds, currencies, ETFs. You can even trade futures on interest rates. It's a truly global market. Now, you don't just use your regular brokerage account for this. Futures trading needs a special kind of account called a margin account. You have to put in a small initial deposit, kind of like a good faith payment to show you can cover potential losses. And it's this little deposit that unlocks the most powerful and dangerous part of futures. Okay, we absolutely have to talk about leverage. This is, without a doubt, the most powerful and, frankly, the most dangerous part of trading futures. It really is a double-edged sword. So what is it about leverage that just cranks everything up to 11? What makes it the source of these incredible opportunities, but also some really significant risk in the futures market? Here's the secret sauce. That small deposit you made, the margin, it lets you control a contract that's worth way, way more. So you're only putting down a tiny fraction of the total value, but you get full exposure to the whole thing. And here's the crucial part. Because you're controlling a huge position with just a little bit of your own money, even a tiny price move in your favor can mean massive profits relative to your deposit. But, and you have to hear this part, the reverse is also true. A small price move against you can lead to gigantic losses, sometimes even more than you put in to begin with. So, with stakes that high, anyone who gets into futures absolutely has to know how to manage their risk. I mean, this isn't optional. It's your essential safety net. Managing your risk really just means having a plan before things go sideways. It's all about setting boundaries on how much you're willing to lose so that one bad trade doesn't completely wipe you out. And luckily, traders have some pretty powerful automated tools to help with this. The most important ones are called stop loss and limit close orders. For now, let's just focus on that key defensive tool, the stop loss. You can think of a stop loss order as your emergency eject button. It's an instruction you set up ahead of time with your broker to automatically close your trade if the price hits a certain losing point that you've already decided on. It completely takes the emotion out of that critical decision. Let's walk through a super quick example.
Let's say you buy an oil future at $80, betting the price will go up. To protect yourself, you immediately set a stop-loss order at $78. Now, if you're wrong and the price starts to fall, the very second it hits 78, your trade is automatically closed. And just like that, you've defined your maximum possible loss on that trade right from the very beginning. Which, of course, brings us to the ultimate question. With the incredible power of leverage to magnify your wins, but also that very real danger of magnifying your losses, is this a game worth playing? And really, that's a question that depends entirely on your knowledge, your strategy, and your personal tolerance for risk. And that's our look at the fundamentals of futures trading. Thanks so much for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.